Welcome to This Explainer. Today, we're unpacking what I think is a pretty fascinating case study in modern banking. We constantly hear about the headwinds and challenges facing the banking sector right now. But today we're looking at a legacy regional bank that isn't just surviving all of that, it is actively thriving in this complex economy. We're going to dive deep into the Q2 2026 earnings for Simmons Bank to see exactly how they're navigating interest rates, managing their deposits, and honestly, driving some serious operational efficiency. Here's how we're going to break this all down. First up, their century of service. Then we'll hit the Q2 financial highlights, dive into revenue and margin trends, look at how they're driving operational efficiency, and wrap up with their deposit strength and liquidity. All right, let's jump straight into Section 1, a century of service. To really understand Simmons Bank, you have to know that they aren't some disruptive overnight fintech startup. Not at all. They are a Mid-South-based financial holding company that has literally been serving customers since 1903. Think about that. Over 123 years of service. In an industry where trust is absolutely everything, having roots that deep gives you a massive competitive advantage when you're trying to navigate bumpy macroeconomic cycles. And if you want a massive credibility hook, well, here it is. 117. That's the number of consecutive years Simmons has paid dividends to its shareholders. Just to put that into perspective for a second, that streak survived both world wars, the Great Depression, and all the recent pandemic shocks. With a current dividend yield of 3.8%, it's honestly a staggering testament to their consistent, conservative management over the long haul. So today, that rich history supports a huge footprint. We're talking 220 financial centers spread across 6 key states. This network dominates markets across Arkansas, Missouri, Tennessee, Texas, Oklahoma, and Kansas. And that footprint? It's supporting an impressive $24.8 billion in total assets, $19.7 billion in deposits, and $10.4 billion in assets under management. And this brilliantly illustrates that their regional dominance isn't just an internal talking point. It's widely recognized, being named among the best companies to work for in the South by U.S. News and one of America's best regional banks by Newsweek for 2025, that really validates that their internal culture is working just as well as their balance sheet. All right, now let's get into the hard math. Section 2, Q2 2026 financial highlights. Let's see how they're optimizing the business. Okay, looking at these quarter-over-quarter numbers, Q2 was just a definitive win. Net income climbed from $66.7 million up to $72.2 million. And that, of course, flows directly to the bottom line, with diluted earnings per share jumping nicely from 46 cents to 50 cents. It's clear their strategic levers are actively working in real time. As we dig a little deeper, one absolutely critical metric we need to look at is PPNR, or pre-provision net revenue. Just as a quick refresher, this metric basically strips out the noise of loan loss reserves. It gives us a crystal clear look at the raw operational profitability of the bank's core engine. And wow, when we look at that core engine, it is running hot. They are officially on track to deliver double-digit PPNR growth for the full year of 2026. The adjusted PPNR for Q2 hit a really impressive $108.2 million. Guys, that's a massive 40% growth year over year compared to Q2 of 2025. It proves without a doubt that their core banking operations are becoming significantly more profitable, completely separate from whatever they might need to set aside for future credit smoothing. Moving right along to Section 3, revenue and margin trends, let's talk top-line growth. So, adjusted total revenue ticked up really nicely, moving from $241.4 million in Q1 to $248.6 million in Q2. But what's truly compelling here is how balanced this growth is. It was led by an 8% linked quarter increase in non-interest income. That was fueled by a solid 6% bump in debit and credit card fees and a pretty remarkable 24% jump in swap fee income. The takeaway? They aren't just crossing their fingers and relying purely on lending. But hey, on the lending side, they are actually holding exceptionally steady. Their net interest margin, or NIM, held perfectly flat at 3.84% from Q1 to Q2. Look, in a rate environment right now where so many banks are facing severe margin compression, maintaining 3.84% is a huge victory. This stability is getting a strong tailwind from the favorable repricing of their fixed-rate loans. Basically, as those older, lower-rate loans mature, they're being replaced at today's much better yields. Which brings us to Section 4, driving operational efficiency. Let's look at how they manage those internal costs.
Because generating revenue is great, for sure, but meticulously managing the internal machine is what actually drives shareholder value. Just a year ago, back in Q2 2025, Simmons had an adjusted efficiency ratio of 60.52%. Fast forward to Q2 2026, and they've driven that down to an outstanding 54.26%. That is a massive 626 basis point improvement year over year, which frees up so much capital to fund their ongoing investments.
Now, what's really interesting here is the real-world business decisions that actually drove that efficiency. During the quarter, they made the tough call to eliminate 39 positions, taking a one-time $1.3 million severance hit to do it. They also exited or optimized 4 different corporate and branch locations, effectively shutting about 53,000 square feet of real estate. And despite those upfront costs, the projected earnback for these specific Q2 initiatives is less than 1 year. I mean, that is just textbook lean management. All right, finally. Section 5. Deposit strength and liquidity. This is the crucial fuel for the entire operation. At the end of the day, Simmons' stability comes down to their deposit mix. A staggering 90.8% of their deposits are genuine customer deposits. Only 9.2% comes from brokered or public funds. Their entire foundation is built on sticky, direct relationships across the Mid-South, not flighty institutional money that's going to vanish when the market gets spooked. And they're actively improving this mix too. They successfully grew their average non-interest-bearing deposits, which is basically free money for the bank to use, by 4% annualized in the linked quarter. Thanks to that and strategically shifting away from some of those brokered deposits toward more favorable Federal Home Loan Bank pricing, they pulled off a brilliant dynamic. They actually dropped their overall cost of deposits by 3 basis points, down to 2.44%, all while simultaneously growing their asset base. So the crucial point here is their massive liquidity safety net. With $19.7 billion in total deposits, funding $18.1 billion in total loans, they are sitting at a very healthy conservative loan-to-deposit ratio of 92%. But you want to know the metric that truly lets depositors sleep at night? Roughly 77% of their deposits are completely protected, either fully FDIC insured or fully collateralized. That right there is what you call an absolute fortress balance sheet. Which leaves us with this incredible forward-looking thought. Right now, Simmons Bank has roughly $2.6 billion worth of loans sitting at a weighted average rate of less than 4% that are scheduled to reprice over the next 3 years. And it gets better. About $1.8 billion of that reprices in just the next 12 months alone. That represents a massive embedded revenue tailwind. We've seen their history, we've seen their operational discipline, and we just looked at their fortress balance sheet. So the real question now is, with this huge upcoming influx of margin expansion, what strategic move is Simmons Bank going to make next? Thank you so much for joining me for this explainer, and we will see you next time.